When we talk about the cycle of poverty, the conversation usually focuses on low wages. But this narrative ignores a series of specific financial traps, small, repetitive losses that are designed to look like legitimate investments. One of the most effective of these drains is the penny stock. These are shares priced at nominal amounts, often just 1, 2, or 5 rupees, presented to the public as accessible entry points into the market. The math of a 5 rupee share feels intuitive to a beginner. If the price moves even slightly, the percentage gain is massive. It offers the hope that a single lucky pick can provide immediate, lifelong financial relief. The reality is that these low-priced shares are responsible for destroying significantly more wealth than they ever create. For both beginners and experienced investors, avoiding years of financial regret depends on recognizing how these stocks exploit specific patterns in human psychology. Imagine two different items for sale: solid gold for 50,000 rupees and a piece of plastic for 50 rupees. The human brain is naturally drawn to the lower number, as we are wired to equate a low price with a bargain. This bias carries directly into the market. An investor sees a share trading at 2 rupees and instinctively assumes the stock is cheap, regardless of the quality of the company behind it. The 2 rupee stock has mounting debt and net losses, while the 2,000 rupee stock has consistent profit growth. Beginners confuse low price for a discount, buying the failing asset. As financials deteriorate, the cheap stock becomes valueless, while the high-value stock climbs. There is also a volume bias at play. Many investors feel a sense of security owning 5,000 shares of a failing company rather than owning just 5 shares of a market leader. Seeing a large number of shares in a brokerage account provides a sense of progress. But the market ignores the quantity of shares you hold. It only rewards the strength of the underlying business. Owning a massive volume of assets with no underlying cash flow is like hoarding thousands of broken bicycles. No matter how large the collection becomes, it never translates into actual wealth. The powerful jackpot illusion reinforces this behavior. Investors hear rare success stories of a 1 rupee stock soaring to 100 rupees, and they begin hunting for the next outlier. This chart reveals survivorship bias. You see the single line representing a success, while thousands of failed stocks that drop to zero remain hidden. Like a lottery, winners get all the media coverage, making millions of losers invisible to new investors. Beyond the math, there is the issue of manipulation. Many penny stocks experience price increases because of the actions of operators, rather than any improvement in the business. This timeline illustrates a pump-and-dump scheme. Insiders buy at the bottom, then use engineered social media hype to drive the price up. Retail investors jump in at the peak. Insiders then sell, and the price drops off a cliff, leaving beginners with valueless shares. In this environment, retail excitement is often the fuel for an operator's exit. That surge in buying volume provides the liquidity manipulators need to sell their positions. This cycle is driven by the pressure of limited capital. When resources are scarce, there is a psychological push for rapid relief rather than the slow process of compounding growth. Penny stocks exploit this urgency by promising the impossible, doubling an investment in a month or finding the next conglomerate for less than 5 rupees. These illusions stand in contrast to the boring reality of wealth building. Sustainable growth is achieved through systematic investment plans and index funds, methods relying on consistency, not luck. These methods do not offer instant gratification or screenshots of massive gains. They require a long-term commitment to patience and a refusal to be swayed by short-term noise. The financial industry often profits by selling excitement to the desperate, while those who actually build wealth do so by quietly using time and discipline. To move past this, an investor must ask one logical question. If these stocks were a reliable path to wealth, why are the buyers usually struggling while the people selling the tips are getting rich? The stock market does not reward desperation or the search for a miracle. It is a system that, over time, exclusively rewards disciplined analysis. Successful investing uses a framework like this one. It focuses on profitability, debt levels, the honesty of the management team, and whether the company's growth is supported by actual revenue. A disciplined investor understands that share price alone is a meaningless number. A 3 rupee stock can be overpriced if the company is bankrupt, while a 3,000 rupee stock can be a bargain if the earnings are high enough. Real wealth is a byproduct of structural knowledge. The process starts when the focus shifts from chasing miracles to evaluating the actual performance of a business.